Checking in on the finance world now, I'm joined by Evan Lucas to talk through, well, what's been a pretty healthy stock market of late. Evan, thanks very much for your time. Let's begin with home loan approvals because they're due out this week. The big question is to what extent it might confirm the housing rebound or it might prove a bit of a false dawn, with always a watch as well in February on whether or not we get real numbers going back into auction rates.
All of those questions are exactly what we're trying to ask ourselves at the moment, Tom, and it's a very interesting one because the reason it's also there, so the numbers that we get this week are for November and also December. It's also the first time that we start to possibly see a bit of a trickle-out effect from the government's first home owners grant scenario, and you've probably been starting to see the banks at the moment are ramping up their current take on it to actually try and advertise out, and you'll be seeing quite a push at the moment, particularly for first home owners, to look into that market. So yes, it's likely to see an increase in home loan approvals. We saw that the fourth quarter last calendar year was actually the strongest quarter that we've seen in over 3, so it's certainly likely to see that. You need to also look at investment loans, and that's the other part of the whole market that started to really move in the right direction. They have fallen off a cliff over the 2 years to December 2019, but just at the back end of last year, it finally turned around, and that's also putting upward pressure. So housing is likely to do quite well. Getting back to your question around February, the other part of that is the RBA, and the RBA is very, very aware that it can create heat inside the housing market. It saw it back in 2016 when it cut rates twice. We saw it cut rates 3 times last year. So that will also be the question now, is that has the housing market really started to ramp through off the back of those rate cuts? As you've also pointed out, there is increased demand finally as there's a bit of reflationary pressure going on in Australia and also globally, and all that is putting upward pressure on that price. So February's not just looking at the numbers with regards to actual home loans and actually new numbers coming through. It's whether or not the RBA starts to suggest that that market may be a reason to hold off cutting rates sooner.
You've got the other factor here, the government's plan, or the government's policy, I should say, on first home buyers, helping out with the deposit, and they need 5% of the deposit for a certain value home across various cities. It covers up to 10,000 people a year. Is that too small to really make much of a difference?
It is and it isn't. I mean, it certainly allows a lower sort of, what we call quartile group of people actually into the market. So there is a positive to it. The risk that obviously everybody highlights, though, is that in the end, they're putting up 5%, the government's backing 5%, so it's 10% deposit, and that is still, in most people's eyes, very, very low in terms of the overall outlay to the debt that you're going to take on. It is always seen that a 10% deposit is a risk. The banks see that as a risk, and therefore even with the new legislation, the way that the government is sort of trying to basically price this is that you're still likely to see the rate that is actually being offered on that home loan for a 10% deposit being higher than somebody looking for 15, or what was really the numbers that you need, 20%. It does also, again, it adds a level of heat because it means, therefore, you do have a new cohort of buyers actually in a market that is already on the way up. If you look into Sydney and Melbourne particularly, you are looking at the average median house price in Sydney of being just on $1 million. In Melbourne, it's sitting at around about 850 with a 10% deposit. In suburbs that these people want to buy, it again creates a level of risk and creates a level of pricing that can sometimes push over to the wrong side. And what everybody, including the RBA and the government, is sort of watching very closely is that you don't all of a sudden see bad and doubtful debts, defaults actually starting to become an increased concern because of this current program.
Just briefly, Evan, the ASX 200's hitting a new record on Friday. It keeps getting up to this 7,000 or thereabouts mark and dropping off again. Is that going to happen again?
Oh, look, today it will. I think the better question, and we've just been discussing about this whole thing, is what 2020 holds. I mean, the argument that comes from a lot of people is that this rally is unsustainable. This is basically the biggest and longest bull market the world has ever seen, not just Australia, but the world has ever seen. It's been going since the GFC, and it's not slowing anytime soon. Everybody then gets questions about whether or not, what is actually being asked as price versus what they're doing in earnings. Is that justified? The way to answer that question at the moment is what we've been discussing around housing. It also comes through into equities. The RBA, the Federal Reserve over in the US, the ECB in Europe, they're all putting more and more money back into their own respective economies, and that is going to one direction. It is not just going to housing and into that sort of part of the economy, it's also going into equities, and that's unlikely to slow in 2020. Our market is obviously going to be supported by probably another 2 rate cuts in this country. It's likely that with the bushfires, as horrible as they are, that amount of funding and stimulus that's going to come from the government and all those charity events will also see a push up in terms of demand. It'll mean wages go up, and that will also mean the equity market follows through. So it will probably mean we go through 7,000 points. There's an expectation at the top end that some people believe will be at 7,500 by December. So it's a very interesting time. It is expensive, I don't deny that, but what it's telling us in the macro market, it's likely to keep going.
We'll see. Evan Lucas, thanks for your time.
Thanks, Tom.